What's going on, guys? Welcome back to the Xavier channel. And in this video, I'm gonna be doing a full stock investing guide for beginners. If you have never invested in the stock market, or you're really new to investing in the stock market and you have no idea what you're doing, this is the video that I wish that I had when I first started investing. Today, you're gonna learn what is a stock market, what exactly are stocks and how people make money from them, the different types of stocks, the easiest way to open a brokerage account types, timing the market, best way to do stock research, key terms, 2 ways to make the money, dealing taxes, beginner tax strategies to reduce your taxes, value versus momentum investing, Warren Buffett, how to hold importance, the importance of investing early, due diligence, and more. I really like this stuff. If you couldn't tell, I really enjoy finance and all that kind of stuff. And on this channel, it is my goal to make finance easy and accessible for every single person. From my background as an investor, I accumulated over $100,000 net worth in pure cash at the age of 21. And just this year, I invested in my first property, and I now have a rough value of about 1 million. It was a pretty big deal, and I have a rough non-cash value of about $1 million right now. And currently, as it stands, if I don't make another dime, but if I keep the money that I currently have in the stock market where it is, I will literally make $4.4 million when I retire. You guys can see right there, $4.4 million. And that's if I literally don't invest anymore. If I invest more, I can make more. And what's crazy is that that money is mostly tax-free, which I'll explain in a second, but it's pretty tax advantageous. Here's why you should have started investing yesterday. First, the potential to make money. Even if you just invested your money in a simple index fund like the S&P 500, which is the most common to do, historically, you will make more money than any hedge fund combined, and you will outbeat inflation. Over the last 4 years, the average inflation rate was 2.5%, and that has increased with the new president. So if you just have, let's say, $10,000 sitting in a bank account, over 10 years, let's say our current president leaves the inflation rate as it is, that is only going to be worth $7,500 because the value of your money is shrinking relative to inflation. So if you literally just took that money and invested it in the S&P 500, you literally would have made an additional $8,000 on the interest alone, and that's not including dividends, but we'll explain what that means in a second. Long-term investing is safer, but the number one rule of the stock market is that nothing is ever guaranteed. But you should be letting your money work for you. This is what all the rich guys do. We're going to talk more about Warren Buffett's investing strategy, but every single rich person that you know, Elon, Bezos, Zuckerberg, they don't let their money just sit around. They do things with it that is going to make them long-term wealth. And what's great about investing is that it's literally the only true form of passive income, because all you have to do is just buy it. And if you get something like the S&P 500 or several tradable ETFs or a ETF of some kind, you will get paid cash dividends every single month. For example, currently the $50,000 that I have inside of my retirement account, I get paid $800 every single month in cash dividends from just owning those stocks. And obviously you're hedging against inflation, which is 2 to 3% every year. Money does lose value over time. And for your money to make money, you have to grow faster than inflation. Compare this to any savings account where on average, you're getting an interest rate of 0.5%. Start gaining assets. This is how to become rich. You get stocks, real estate, or other assets that generate you money. Retirement is honestly the number one reason to invest. Any millennial that's smart is prioritizing their retirement over debt. Any person that's smart should be prioritizing their retirement over literally anything else. Because I don't know about you, but I don't want to be working well into my 60s. I want to be done with it. And I feel so financially secure now, knowing that if I literally just don't touch anything, if I just don't touch that base level of money that I have, I'm going to be financially secure for most of my life. And 56% of people would agree with me. When they invest in their retirement, it makes them feel better. They feel financially secure and they are maximizing their wealth. But despite that, 76% of people say they're not saving enough. This is the number one activity they say they need to do more of. 39% of millennials expect to work well beyond retirement age, and 12% don't even contribute to a retirement fund at all, which means that 12% of all millennials are going to be working for the rest of their lives, which is obviously bad. So you want to invest. You want to get started investing today, but what are you exactly investing into? I've said a lot of things like an ETF, stock market, but what the hell even is a stock market? Stock market is a marketplace where buyers and sellers trade shares in companies. It is regulated by the SEC. These are publicly traded companies, the owners of which dilute their personal equity in exchange for capital. So basically what's happening is that a company, let's say Amazon is like a company. So essentially what's happening is somebody like Jeff Bezos, for example, wants to raise money to grow Amazon. So he says, we're gonna take 30% of Amazon and let anybody buy from it. That's what people are doing when they're buying a share from Amazon, because there is a set number of shares that you can buy. Because there is only a specific amount of shares that you can own, and the more people that buy them, the more that the share price is gonna go up, the more that the company makes money, the more that the share price is gonna go up as well. And the reason why companies do this is so that they can get paid a bunch of money that they can then reinvest back into the business. When this first happens, this is what's called an IPO, an initial public offering. Investment banks underwrites the IPO, buying up shares, they're taking risk, and then they sell the shares on the market for a fee. This is what we call a broker. That's what we call an IPO. Now, what is an IPO? Essentially what that is that's called an initial public offering. That's when a company first decides to sell off some of its equity in exchange for cash. An investment bank underwrites that, so that means that they're taking on all the risk for it, they're buying up all the shares, and then they sell those shares on the market to any investor for a fee, which they usually take a percentage of a share price. There are 13 different exchanges in the US, NYC, NASDAQ, and more. These allow individual investors to buy and sell in the regulated environment. It's essentially an auction house where you can say, hey, I will take your stock that you're selling right now for 400 and I'm gonna hold it, and if it gets to 500, let's see if somebody then buys it. Now, the definition of a stock, quite literally, it is a piece of a company. Your share of ownership in a corporation, it is a type of currency that is backed by the company. The units or stocks are called shares, and corporations issue stocks to raise funds to operate and grow their businesses. In terms of types of stock, there's a common stock, which ownership in the company and right to vote, where you get dividends, which are variable and not guaranteed. So this is essentially when you can buy a chunk of a company and end up on the board of directors where you can create decisions. That's not something that we're really gonna be talking about in this video. And then number two is a preferred stock. This is when you get no voting rights, so this is what happens most of the time when you buy a share from Amazon or whatever. They get a more stable dividend, so you're basically guaranteed a certain amount of cash that the company makes for owning that share, and you're guaranteed to get paid out first in the case of bankruptcy or insolvency, but they're harder to lose or gain value. Then there's categorizing stocks, so this is small, and those are divided into small, mid, and large cap. We'll talk about those more in a little bit. There's sectors, which is essentially just a collection of a bunch of different stock in a different kind of thing. And then finally, an ETF, which is a tracked index or a mutual fund. This is what the S&P 500 is. Basically, all the S&P 500 is, it is a collection of a bunch of different stocks in a pot that you can buy a chunk of. And for the S&P 500, the reason why it's called the 500 is because it's just a representation of the top 500 companies in the United States. So if you buy the S&P 500, essentially you're buying into every single major company. So think Tesla, Amazon, Google, and many more. If you're a beginner investor, I would recommend sticking with ETFs. You can dabble into preferred stocks, which is when you're buying a specific stock of a company, but generally speaking, I'd recommend just staying away from things like categorizing stocks and sectors, and that's gonna be too complicated for the scope of this video. Now, let's talk about risk tolerance. This is essentially the level of risk when it comes to the potential of you losing money. You got cash first. Cash, it's stable, right? There's no way, except with inflation, that your cash is gonna lose value, but inflation, you know what it's gonna be, it's a set percentage. Cash and then bonds. Bonds are really great because bonds are backed by the US government. Again, this video is mostly for US people, but you can buy bonds of any country. All a bond is it's basically just saying, hey government, I'll give you some money and you give me some money back on interest. There's a bunch of different kinds of bonds, and bonds round out a portfolio really nicely in the short term, because since they gain value at a consistent rate and you're paid a set consistent rate from the government itself, it's usually about 3, maybe 4% depending on the bond. That means that if you keep some bonds in a portfolio, your portfolio is not going to have as much risk compared to the other things that you're buying, simply because it's gonna maintain a steady level of value just because it's literally a steady asset. Bonds are also more secure than cash, so at a minimum, if you take anything away from this video, please invest all of your spare money just into bonds. I'll show you exactly how to do that near the end. Next up is index funds. This is personally what I have pretty much all my money into right now. And the reason why is because index funds, specifically S&P 500 and most ETFs, see an average growth rate year over year of about 8 to 12%. Index funds are just like stocks, they go up and down quite a bit. So some days your portfolio is gonna have a lot more value, some days your portfolio is gonna have a lot less value. But There's a recent study that just came out of France, I think, where they took a bunch of data together and created these models that basically showed that an investor who just kept index funds always had more money. And the reason why is because index funds just gain more value over a longer period of time, even though there's a lot more fluctuation. By the way, in stocks, what we call fluctuation is spread. So if I refer to spread throughout this video, that just means that the rate of which it's going up and down. Next up is individual stocks. These have way more risk because companies can go bankrupt, but it's pretty rare for an entire index fund to lose all of its value. Next up is real estate. It's easy to fuck up real estate. There's tons of people that have messed it up before. And look at 2008, housing can crash, it is possible. And then finally, crypto. Crypto is gambling. I refuse to admit it's anything but. I don't really have any crypto in my portfolio, but I'll show you how to buy crypto if that's something that you're interested in investing in, but I don't recommend it for the average investor. It's gambling. Crypto is really, really weird. It's new and it's definitely just gambling, and it's a player versus player game where the player that you're playing against knows way more than you, has way more insider access, and you're just likely to lose money. If you're really confident about crypto, you could just put some into Bitcoin and just hold, or Ethereum and just hold, but I would not recommend fucking with meme coins. You're just gonna lose money. Everybody who invests in them, literally 99% of people who buy meme coins lose. So that's just something to keep in mind. Next up, we're gonna talk about the different kinds of brokerage accounts and the ones I would recommend specifically. The first one is called a taxable account, which is standard. That's when you pay taxes on any gains, which taxes are an important thing to mention, and you can hold any kind of anything in it. It is a cash versus margin account, and it has no limits for withdrawal and entry. Second is retirement accounts. These are tax advantages in a lot of different ways. A Roth IRA, for example, you have to pay taxes on the money going into it, but you don't have to pay taxes on any of the money going out of it. About a third of the amount of money I have in my retirement right now is for my Roth IRA. And if I keep investing, and as it stands right now, my Roth IRA is gonna be worth $1 million when I retire. There's also a SEP IRA, which is a kind of IRA I have personally. And the reason why I like a SEP IRA is because you can invest up to 30% of your paycheck into it, and that is a tax write-off. So for me personally, I'm a full-time content creator, I work remote, and I make a pretty good amount of money, and I don't have to spend that much money. So a SEP IRA is really good for me because it's tax advantageous, because I can write it off today. But when you withdraw that money, you do have to pay taxes on it. But you don't have to pay capital gains tax as long as you wait till when it matures when you turn 61. And then there's also a 401k. I think 401ks suck. Roll your 401k into a Roth IRA. And the reason why 401ks suck is because the commission rates that brokers get for 401ks is way too much. They take like 30% of all your capital gains. That's why companies push 401ks, because they know they're gonna be making so much fucking money with it. If you have a 401k, roll it into a personal Roth IRA or a SEP IRA. Retirement accounts also have contribution limits. So for example, with a Roth IRA, you can only invest $7,600 a year into it. And with a SEP IRA, you can only invest 30% of your total paycheck into it. But they reduce the amount of taxes that you're paying, which is good, and the withdrawal rules are obviously a con. And there's a ton of other accounts, like a health savings account, 502 savings plan, custodial brokerage account, and robo-advisors. We'll be talking about my favorite robo-advisor that I personally use for my retirement accounts in just a second. Now, let's say I've convinced you and you wanna open a brokerage account of any kind. There is a bunch of different ways to do it. Essentially, what a brokerage account is what allows you to buy and sell stocks. As an individual investor, you can't just go to the NASDAQ office and just buy it. You have to go through a brokerage. And where these brokerages make their money is something that's called a swap percentage. What that is that's the commission on how much you pay. So for example, something like Robinhood takes 2% for individual stocks, both on the sale and on the buy. Personally, I would recommend the app-based brokerage SoFi, which I have a link in the description that will give you free stocks when you sign up for it and a free $300 upon opening an investing account and funding it. I recommend SoFi for individual stocks specifically because their swap percentage is only 1%, which is way less than most places. And there's no minimum account balance. It's easy to open. You do have to be 18 plus, but if you have a parent or guardian's permission, you can open it even if you're younger. Now, I would recommend for your retirement account opening a robo-advisor. And for your retirement account, I would personally recommend Acorns. Acorns is what I use for both my SEP IRA and my Roth IRA. And what I love about them is that they offer a 3% match. So for me personally, I invest about $1,000 into my SEEP IRA every single month, and I get a 3% match, which means that I get a free $30 literally just for investing. It's great for beginners because the smart people at Acorns do all the work and it's easy to set up. It literally takes less than 5 minutes. There's no minimum account balance opening, and they have this thing called a roundup feature. So if you don't have the money to set aside a specific amount to invest every single month, Acorns will round up any purchase that you make. So let's say you buy a bunch of stuff at like $20.40. Acorns is gonna round up that 60 cents and then put that into your investment account for you, which is really, really cool. Plus, Acorns allows you to choose either stocks or bonds to invest in, and they give you a percentage, of what you want. Me personally, I'm 100% in stocks because I'm planning on writing this for the long term. But if you just want something small that you can just invest some cash into just to beat inflation, picking bonds is a really, really good option. Now, the application process to open a new account, once you guys use the links in the description to get free money and free stocks, you have to submit an application. It'll only take a couple minutes. You have to put in your personal information, things like SSN, address, name, date of birth. These two companies, Acorns and SoFi, are 4.5 minimum star rated on Trustpilot. They are totally trustworthy with all that information. They are absolutely trustworthy with all that information, and they're gonna ask you to verify your identity, usually by asking you to scan your driver's license. You gotta wait for your application to be approved and then fund your account and start trading. Now, the reason why I like Acorns and other robo-advisors is because they are passive investing platforms that help invest your money for you. They are automated, they use algorithms to help you invest in stocks, and they're inexpensive. The swap percentage for a IRA of any kind is only 0.25%. They're inexpensive, algorithm-based financial advisors that are perfect for people who don't want to spend their time following the market, which I don't. I'm busy, I got YouTube videos to make. And they also require less capital to start, and they have low fees compared to human financial advisors. Now, let's also talk about the different types of trades. Number one, it's a market order, a buy or sell at the best available price in the current market. A, it's the fastest way to buy and sell. B, it's the most basic type of buy and sell. And C, it's buying at the current asking price or selling at the bid price. 2 is what's called a limit order. This is when you buy or sell at a specific price of your choice. You order only if the stock exceeds that price. For example, if you have a set order limit of $15, it'll then buy it when it hits $15. Or if you have a sell limit, it'll then automatically sell it when it hits $20. There's also what's called a stop order, when you buy or sell a stock when the price moves past a specified price. This is important because let's say a stock is tanking and you don't want to lose that much money. You can hit that stop order. That stop order will hit and then boom, you're not out. And then boom, you're out. Next up, here's how to research stocks. These are the most important metrics to understand. Number one, it's the price. It's the cost to buy the share of the company. 2, it's context. What is the company? What are they doing? Why is it a good investment? Find that out. Number 3, their 52-week low and high. This is just how much was the stock. This is just how big and how low was the stock over the last year. Next up is the trading volume. It is the quantity of shares being traded during a given period. For example, if there's a lot of people starting to sell, maybe it's time to buy. For example, if there's a lot of people selling, maybe you look into why they're selling. Or if there's a lot of people buying, why are they buying? Next is market capitalization. This is the total value. This is just how much it's worth. So for example, Nvidia has a $3 trillion market value. Next up, it's the beta. So this is the stock's volatility in relation to the overall market. So how fast is the stock moving compared to the market? This is important to know so you know if it's like just some kind of hype pump stock. And finally, you'll really figure that out with the price to earnings ratio. This is the price per share divided by the annual earnings per share. Generally, if a company is above a 25-20 P/E, that means that they're probably a hyped up company. For example, Nvidia right now is like a 50 P/E, which is crazy. That's why when DeepSeek came out, their stock tanked by 20% because the entire stock is built on hype. But if the P/E is under 20, that is a really, really good ratio. Maybe it's time to invest in that stock. For example, Berkshire Hathaway, Warren Buffett's investment firm, has a 11 P/E, so I personally invested some in there and we'll see where it goes. Here's a couple more important metrics to understand. The PGE ratio, which is the price to earnings to growth, which just means what's the price to earnings relative to its growth. So how fast is the company growing? The P/E ratio divided by the growth rate of its earnings for a time period, that's what the PEG ratio is. It helps you value a stock when factoring in its expecting earnings growth. And it's a standardized way of comparing companies with different growth projections. Lower is better, under is undervalued, undervalued and over is overvalued. Here's an example of a PEG ratio. Company 1, its price is $10, EPS this year is $1, and EPS a year ago was 66 cents. The P/E ratio is 10, the earnings growth rate is 1 divided by 0.66, minus 1 equals 52, which is 50%, which is 52. 10 divided by 52 is 0.19, which is really, really low. Company 1, the price is $10, and the EPS this year is $1. The EPS a year ago was 0.66. PE ratio is 10, the earnings growth rate is 1 divided by 0.66 minus 1, which is equal to 52. 10 divided by 52 is 0.19, which is really, really low. So that means that this is a good time to buy. Another thing to understand is dividend yield. I talked about this a little bit ago, but this is exactly how much a company pays out in dividends each year compared to its stock price. The annual dividends per share divided by the share price is expressed generally as a percentage. This is called the price to book ratio. The stock price divided by the book value per share, it tells us the market valuation of a company, which is usually higher relative to its book value. Book value is found from the net assets of the company, which is assets minus debt, that's book value. Under 1 is good, over 1 is overvalued. Here's how to time the market. Number 1, what's the definition of timing the market? It's trying to predict the stock market and using those predictions to influence your buying and selling pattern. Historically, it's been better to buy after a crash and then try and time a market high. Stocks tend to recover, generally speaking, must be a good company that'll survive a crash or economic downturn. It's better to buy after a large crash. Don't sell during small crashes, this is called panic selling. Focus on the long term, hold as long as you can. Holding longer makes investing safer. Safe answer, timing the market is bad, rather spend more time in the market. So if you're not interested in gambling, basically, literally just pick a stock, pick an investment platform, pick an index fund, pick an ETF, pick a whatever, buy that, hold for 20 years, you'll have money. Now, let's talk about the dollar cost averaging strategy. This is when you gradually invest into a company over time instead of all at once. This is a good tool for investors who want to limit risk exposure if a crash occurs, which we might be heading towards. Historically, since market generally moves up, it should be technically better to buy at once. But in volatile markets, DCA can be a great strategy. If you're somebody who's like a little bit iffy, you don't really know how to handle it, and you're really, really concerned about risks, just invest slowly. Now let's talk about the difference between appreciation and dividends. Appreciation is when a share price rises due to a company's performance and their market sentiment. Sell higher than what you bought to see a capital gain, obviously. It's not guaranteed, keep that in mind. Dividends are paid out quarterly or monthly. They are recurring income and they can invest in or pull out. So for me personally, for my index fund portfolio, I have all the cash dividends reinvested. So that's why compound interest is so powerful, because you're reinvesting the dividends. So over time, your money just grows and grows and grows. And you are paid from company profits. Now, can you buy right before an ex-dividend date? The answer is no. Most of the time you have to hold a stock for a while to get a dividend. Many companies will appreciate and pay out a dividend, as well as a lot of index funds and ETFs. Now let's talk about taxes. This is the fun part. What happens when you sell a stock? You will be taxed when you sell a stock or any capital asset for more than you paid. That's capital gains. Keep in mind, you are not taxed on the money that you put into stocks. Provided you've already paid taxes on that money, you're not gonna get taxed again when you pull it out. You will only get taxed on the gain. Taxes are something important to consider when you're selling. If you're willing to eat those taxes, then it might be a good time to sell. Long-term capital gains. Now keep in mind, guys, there is 2 different kinds of capital gains. All right, what exactly happens when you sell a stock? First off, you will be taxed when you sell a stock. This is called capital gains for more than what you paid. So if you bought a stock for $2,000 and then sold it for $3,000, you will pay capital gains tax specifically on that $1,000 in profit. Capital gains isn't the exact same as income tax, so let me explain. First off, long-term capital gains versus short-term capital gains. There's 2 different kinds of capital gains tax. If you buy a stock and you sell it before 1 year, that profit will be taxed as ordinary income. But if you hold it for more than a year and then you sell it, you will have to pay only 20%, 15%, or even as low as 0% depending on your income level. In general, holding for over a year is going to reduce the amount of taxes you're going to pay. Your brokerage is also going to send you a tax document each year with your exact capital gains and losses, so there will be no confusion. For long-term capital gains, for a tax rate of $0, you have to have an income of only up to 40 grand. And if you're married filing jointly, that can be up to 80. For 20%, you have to be making over $500,000. So capital gains is actually not nearly as bad as people think it is. And keep in mind, guys, you can write off the taxes that you would have to pay into capital gains as a write-off. So if you have business expenses and your capital gains cover that, you can write it off. For short-term capital gains, here's the exact taxable income range. So if you're filing single, it'll be different if you're filing married jointly, but you will only have to pay as little as 10% if you only make $10,000 a year. And you'll have to pay 37% in capital gains tax if you pay greater if you make more than $500,000. And keep in mind, these are tax brackets, so that means that that's only for the money that you're getting that much taxed on. So that means that you're only paying 37% on any money that you make in capital gains that's more than $500,000. A quick retirement account overview. I've said some of it before, but I want to say it again. Everybody should have a retirement account solely for the tax advantages. Like I said, with the SEP IRA, you can invest up to 30% of your paycheck, and that is a tax write-off. A Roth IRA is also really good because that money that you pull out is completely tax-free, and you have to pay no capital gains or even income tax on it. You do have to wait till when you're 60 to pull out the gains in retirement, but compare this to a normal taxable account where you're taxed twice, both capital gains and then income tax. You can contribute up to $7,600 a year. This is wrong. Acorns is a great option for this. You can invest in other retirement accounts that you can research yourself. Roth IRAs are not the only option. There's 401ks, which I don't like, and traditional IRAs, which do different things. Now, I want to talk to you guys about tax loss harvesting. This is how I offset capital gains tax. Basically, you share your shares at a loss to offset the capital gains tax liability. So you sell stocks that you lost money on, or you create a loss artificially to offset any gains in that year. Then you can replace it with a similar asset. But keep in mind, guys, of the wash sale rule, which is you cannot repurchase a stock for 30 days if you claim it as a loss for tax purposes. So it's totally legal to do this. You just can't do it multiple times with the same stock. Let's take an example for tax loss harvesting. If I had stock A for 6-7 days and I wanted to sell it, the total gains I made was $100,000. That results in $100,000 short-term capital gains, taxed at 37%, $37,000 in taxes, which isn't really how it works because it's tax brackets, but let's just make it simpler. But let's say you also had stock B for 180 days and now you can sell it. Your total loss in that stock was $500,000, which results in a $50,000 short-term capital loss. 100 minus 50 is 50K short-term capital gains, which means that you're only paying $18,000 in taxes. This is great for realizing tax savings when you want to sell a specific asset for a profit. Now let's talk about Warren Buffett's value investing principle. Warren Buffett's principles of investing is the leaders are important. Invest with facts, not emotion. This is why I don't invest in Nvidia. You invest for the long term. Don't sell unless the business changes fundamentally in a bad way. And for 95% of people, an index fund is best. Buy what you know, and when you see an opportunity, take it. Basically, what Warren Buffett would do is that he would buy his way onto the chairman board of a company that he liked for whatever reason. He would not mess with the leaders and make sure that the company culture is unchanged and it continues to grow. And then he would invest even more money in the companies that he knew would be good. The reason why I like value investing instead of momentum investing is because with value investing, you do fundamental analysis and you find companies that are undervalued compared to their intrinsic value. Buy undervalued, hold long term until the company becomes overvalued. I like value investing more than I like moment/growth investing, which is just, you're just kind of gambling and saying like, oh, well, this company might grow big for some reason. Let's invest in this AI company. What do they do? I don't know. Now, this is the point of investing early. It's compound interest. The reason why is because, check this out right here. If you make an initial investment of $6,000, you pay $500 into it for 40 years, there's an estimated interest rate of 7% with a compound frequency of annually. You will have almost $1.3 million with only about $200,000 in contributions, which means that you made $1 million. This is why investing today is better than investing tomorrow. As they always say, the best day to start was yesterday, but the second best is today. This is the impact of investing early. Here's 3 different examples of people who invested at different times. Let's take Joey. Joey invested $200 per month starting at age 41. He contributes $48,000. He only has a net worth of $100K. Jill invests $200 per month starting at age 35. She has a net worth of $250,000. But let's take Jack. Jack invests $200 per month starting at age 25. He contributes a total of $96,000 and he has a net worth of over $500,000. As you can see, the amount that you're paying into doesn't matter as much as the time when you start. Here's my straight up opinion on how you should invest. Keep in mind, I'm not a financial advisor. I just have a master's degree in finance. I personally invest in myself. This is not specific to any kind of financial advice. Any decision you make is all on you. What I would recommend is that you invest the money you don't need to live, all of it. This is why raising your income is so important. It's because the rich get richer. I actually post a bunch of free game on like how I started my YouTube channel and how I make over 6 figures doing remote work anywhere in the world through YouTube. All on my Telegram for completely free. That's gonna be available in the description. But raising your income is important. It's the easiest way to get rich is just to make more money. And the rich always get richer. If you're young, you have excess cash, open up an account after watching this video or scroll down and start one today. Get the ball rolling as fast as possible. However, probably better things to invest in with a higher IRA, building a business, education, but anything that'll get you over this initial hump of starting to invest. Set a monthly goal of how much to invest based on your income and prioritize index funds. This is why I personally like Acorns, because they just take the money out of my account like that and I don't have to worry about it. Always make sure to do your due diligence. So the Securities Act of 1933 makes brokerages disclose specific info about securities before they can be sold to the public, but you must do your own research before investing in any stock. My golden rule is about an hour of research minimum, or you could use a robo-advisor like Acorns if you don't feel like doing research. But different stocks work for different people. You might enjoy a certain level of risk to reward. The timeline is different. For me personally, I want to invest for the long term. Like I'm talking minimum 40 years, but you might want to only invest for a couple years. And you might have a certain opinion about certain companies and industries. Me personally, I think AI is a waste of time. I think it's completely useless. So that's why I would never invest in Nvidia or Facebook or Google, because these people are really putting a lot of time into AI and I think it's useless and not helpful. And I think it's just a massive pump and overvaluation. And that's my genuine opinion. And that's why I don't invest in any of those companies. And that's why I don't invest in any of those companies. But if you believe in it, if you think it's actually useful somehow, you should invest in it. In terms of 2 books I'd recommend if you really want to get into this, The Intelligent Investor by Benjamin Graham is really good, and The Investing Quick Start Guide really helped me learn a lot of the specifics. And I'm gonna tell you some actionable steps to take today. If you watch this video till the end and you're not willing to take action, then I don't know what to do for you. I literally gave you all the golden tidbits in this one video. There's so much game in this video, dude. I put so much work into this presentation. Please take some of these actionable steps. If you take one of these actionable steps, please leave a comment and let me know. I read every single comment. I want to see every single one of you get rich and live a long, happy, and successful life. First thing you should do is open a stock brokerage account and get some free stocks and some free money. If you use the links in the description, you support my channel, you support what I do here, you support me giving out free information just like this. There's literally like college courses inside of this lecture I just gave you today. And then just start by funding your account. Do your due diligence and buy your first stock. I like Acorns. If you're somebody who's really iffy about investing and you just want something that'll invest for you in a good retirement account so you are financially secure for the rest of your life, because to me, there is no better life upgrade than not worrying about money. I know that I'm gonna be good no matter what, and that principle alone makes me so happy and so content. Acorns, and that's why I'd recommend anybody to use Acorns. And if you sign up to Acorns using the link in the description, you get a free $5 for doing so. And it'll support the channel. Or maybe you wanna buy some real stocks. You wanna buy some individual stocks in some companies. Maybe you like NVIDIA for some reason, and you're really interested in that. I'd recommend SoFi because their swap percentages are really small. And if you sign up using the link in the description, you'll get a free $300 to invest in, as well as a couple free stocks, and you'll support me and support this channel. Make sure to keep learning about the stock market. Subscribe to my channel. I got a bunch more videos coming out. I have made a bunch of videos on things like high yield savings accounts. I got a video coming out on health savings accounts very soon. I want to put out as much information on the internet as possible for you guys to enjoy. I want to spread this information. I believe it is important to be known, and I want to do my best to see every single one of you be financially secure. That is my mission right now, is to help as many people as possible get stinking rich in a good way. I don't sell a course. I don't sell any kind of like stupid mentorship service. If you want to support this channel, watching this video to the end and signing up with the links in the description is the best way to help me and help me fund future videos. Thank you guys so much for watching, genuinely from the bottom of my heart. It is a huge step just to sit down and watch this video. You should be proud for yourself. I have sat here rambling for the last hour and a half. There is a lot of information I put into this video for you guys, and it's a lot to take in, and the fact that you were able to sit with it till the end and sit with me and learn a little bit means the world, and you should be proud of yourself. Even if you don't take any actionable steps, I'm proud of you for sticking till the end, because that means that you learned something, and that means that you did something important today. Thank you again so much for watching. I'm really excited to keep making videos like this. Is a dream of mine. I want to help as many people as I can with their finances. Thank you guys so much for watching. I'm gonna stop rambling. I'm gonna go get some more because I'm tired. Thank you so much for watching, and hope that you have a good day, genuinely.